Every trader dreams of explosive returns, yet very few ever bridge the distance between desire and disciplined execution. The truth is simple. Markets don't reward intelligence alone, they reward structure, behavior, and emotional balance. The secret isn't hidden behind complex algorithms, expensive indicators, or market predictions. It lies in a single habit that reshapes the way you experience uncertainty, manage risk, and respond to opportunity. This habit is not glamorous, but it is transformational. It rewires your relationship with the market from the inside out, turning inconsistency into clarity and randomness into a controlled edge. What separates the trader who keeps losing from the trader who compounds? It's never the market. It's never volatility. It's never the strategy. It's always the internal environment you trade from, the habits that govern your decisions. Most people never realize that their biggest losses didn't come from bad setups. They came from a lack of consistent behavior. They came from moments when emotions replaced rules, when hope replaced logic, and when fear replaced confidence. One habit has the power to bring stability where chaos used to exist. This habit is the ability to treat every trade as a singular, independent event while executing your plan with unwavering consistency. It sounds simple, almost too simple, but that's exactly why most traders ignore it. They chase excitement instead of discipline. They chase certainty instead of probability. But when you anchor yourself to this habit, you strip away the illusions that cause traders to fail. You stop expecting the market to behave the way you want and start responding to what the market is actually offering. When you adopt this habit, the noise of the market stops controlling you. You stop reacting to every tick, every candle, every spike of emotion. You begin to operate from a mindset where each decision is informed by process rather than impulse. Suddenly, winning trades don't excite you, losing trades don't shake you, and the market no longer feels like a battlefield. It becomes a structured environment where you manage risk, execute your edge, and let probabilities unfold naturally. Trading becomes less about predicting outcomes and more about performing consistently. You develop a trust in your rules, a peace with uncertainty, and a confidence that doesn't depend on short-term results. This habit becomes your anchor, your invisible advantage that most traders never develop because they're too focused on results instead of behavior. When this habit becomes part of your identity, your returns don't just grow, they multiply. Because compounding doesn't come from big wins. It comes from disciplined consistency. It comes from doing the same correct action repeatedly until the market rewards you. It comes from removing the emotional chaos that once caused you to deviate, hesitate, chase, or panic. This habit is the foundation of professional level performance. It's the difference between a trader who survives and one who thrives. It is the quiet force that transforms your trading psychology, sharpens your execution, and ultimately 10 times your return. Not through luck, but through mastery of behavior. Treating every trade as an independent event is one of the most powerful yet misunderstood principles in trading psychology. Most traders think they understand it, but very few internalize it deeply enough for it to shape their behavior. On the surface, the idea sounds simple. Each trade has its own outcome, separate from the previous one, but the real meaning goes far beyond that. It is a shift in mindset that completely transforms how you see the market, how you react to wins and losses, and how you execute your strategy. It breaks the emotional chain that keeps traders bound to fear, hope, and expectation. It frees you from the psychological weight of what just happened or what might happen next. It redefines your relationship with randomness, probability, and discipline. Most traders unconsciously link their current trade to the previous one. When they win, they assume the next trade should also be a winner. When they lose, they assume another loss is coming. This emotional linking creates destructive patterns. Increasing position size after a win out of confidence. Decreasing size after a loss out of fear, hesitating to take the next valid setup because the last one failed, or forcing trades because the last one succeeded. What ends up happening is that the trader is no longer responding to the market. They are responding to their emotional memory of the last outcome. The market stops being a series of opportunities and becomes a psychological battlefield. Treating every trade as an independent event breaks this cycle. It makes you realize that the market does not care about your previous trade. The chart has no memory of what happened to you 5 minutes ago. Your last win doesn't increase the probability of the next win, and your last loss doesn't decrease it. Each setup has its own edge, its own probability distribution, its own structure. The only thing that matters is whether this individual trade meets the criteria of your strategy. Nothing else has meaning. Nothing else deserves your emotional energy. When you adopt this mindset, you stop carrying emotional baggage from one trade to the next. A losing trade doesn't make you anxious or hesitant. A winning trade doesn't make you euphoric or reckless. You no longer feel the need to chase, avoid, or make up for anything. Each moment becomes fresh. Each decision becomes clean. Each trade becomes an opportunity to execute your plan without emotional interference. Emotional independence is what allows true consistency. When traders attach meaning to a single trade, they distort their own performance. They start thinking in terms of this must be a winner. I need to recover the last loss. I should protect my profits, or he can't afford another red trade. These thoughts create emotional tension, and tension leads to impulsive decisions. It leads to early exits, skipped entries, oversized positions, or staying in a losing trade longer than your rules allow. Once emotions take over, your trading stops being a systematic process and becomes a series of reactions. By treating each trade independently, you remove this emotional distortion. You stop expecting the market to give you something. You stop demanding validation from a single outcome. You stop needing the next trade to fix anything about the previous one. You begin to trust your edge over a series of trades, not one trade. You start thinking like a casino. Individual outcomes don't matter. The long-term probability does. This is the mindset that allows professionals to remain calm through losing streaks and winning streaks with the same neutrality. This perspective also prevents traders from falling into the illusion that they can control outcomes. Most people subconsciously believe their next trade should behave according to their emotional state. If they feel confident, they expect a win. If they feel fearful, they expect a loss. But the market is not influenced by your feelings. Once you internalize that every trade stands alone, you free yourself from the need to control or predict what cannot be controlled. You start focusing on what is within your control: the setup, the risk, the entry, the exit, and your state of mind. Another crucial element of treating each trade independently is maintaining uniformity of execution. If every trade is a new event, then every trade deserves the same level of focus, discipline, and respect. You stop giving more importance to a trade because you are on a losing streak, or because you are close to a weekly goal, or because this setup looks extra good. Consistency in behavior becomes possible only when you remove the variations caused by emotional influence. When each trade is approached with the same neutrality, you naturally follow your rules. You size correctly. You manage risk properly. You exit without hesitation. You no longer distort your system by overreacting to temporary outcomes. This mindset also deepens your understanding of probabilities. When you truly see each trade independently, you no longer judge your performance by a single result. One loss doesn't feel like failure, and one win doesn't feel like success. Instead, you begin to measure your performance by how accurately you follow your process. You realize that the only thing you can control is execution. And the only thing that creates long-term returns is the cumulative effect of correctly executed trades. This is why professionals remain unaffected by variance. They have mastered the emotional and mental separation that most traders never achieve. Traders who internalize this principle also experience a significant reduction in psychological pressure. They stop fearing losing streaks because they know each trade has its own probability. They stop expecting winning streaks because they know randomness plays its part. This reduces anxiety, eliminates the need to be right, and allows for objective decision-making. When you're no longer carrying emotional residues from previous trades, you become mentally available for the present moment, which is where every trading opportunity exists. Finally, treating each trade as independent creates a stable internal environment. You no longer swing between extremes. You no longer collapse after a loss or explode with confidence after a win. Your emotional energy remains steady because nothing is overweighted. Every trade becomes just another expression of your edge, another data point in a larger probability curve. When your mind is stable, your performance stabilizes automatically. Methods don't fail because of markets. They fail because of inconsistent execution. Clear, unbiased execution becomes possible only when each trade stands alone in your mind. Executing your edge with absolute consistency is the dividing line between traders who grow steadily and traders who stay stuck in cycles of unpredictability. Most traders spend a tremendous amount of time searching for the perfect strategy, the perfect system, or the perfect market condition. Yet very few understand that the real power lies not in discovering a new edge, but in applying the existing one the same way every single time. An edge is nothing more than a statistical advantage, a slight tilt in probability that gives you a long-term benefit. But that advantage becomes meaningful only when it's repeated with unwavering precision. The moment you deviate, hesitate, or selectively apply your rules, the entire edge collapses. What destroys traders is not a lack of knowledge, it is the inability to behave consistently under uncertainty. The market is a place of constant randomness, and in that environment, consistency becomes your anchor. Without it, your results will appear chaotic because your actions are chaotic. A strategy may have a 60% probability of success, but if you only execute it 40% of the time it appears, the edge cannot express itself. The numbers don't have space to play out. You cut off the probability before it has a chance to unfold. Most traders never realize they aren't losing because their system is bad. They're losing because they apply it inconsistently. Skipping one trade here, entering early there, adjusting risk midway, taking an unplanned trade out of boredom, all of these distort the statistical foundation of the edge. You can't expect consistent results from inconsistent behavior. Executing your edge with absolute consistency means committing to a process that doesn't depend on how you feel. It doesn't depend on whether the last trade won or lost. It doesn't depend on whether the setup looks better than usual or feels uncomfortable. Feelings have nothing to do with probability. The edge is in the system, not in your emotional interpretation of the situation. When you allow emotions to influence your behavior, you're effectively allowing randomness to override structure. Emotional trading guarantees inconsistency, and inconsistency guarantees losses over time because you're no longer operating within the statistical framework that gives your edge meaning. The consistency required to express an edge begins long before you place a trade. It begins with the clarity of your rules. If your rules are vague, flexible, or open to interpretation, then your behavior will naturally be inconsistent. A trader who wants consistency must define their edge in exact terms. Entry conditions, stop placement targets, risk per trade, position sizing, and conditions that invalidate the setup. Every detail must be so clear that there is no room for hesitation or guesswork. This clarity removes the need for emotional decision-making and creates a structure that forces disciplined behavior. Once the rules are clear, the next step is the willingness to follow them without exception. Many traders understand their rules intellectually but fail to apply them during real market conditions because emotions become louder than logic. Fear tempts them to skip trades that look uncertain. Greed tempts them to increase their position size beyond what the rules allow. Impatience tempts them to take trades that aren't part of the system. These deviations might feel small in the moment, but they compound quickly and destroy the entire performance curve. Consistency requires a mental environment where the rules are absolute and your personal feelings are irrelevant to execution. One of the biggest obstacles to consistency is the trader's relationship with individual outcomes. When someone becomes overly attached to the outcome of a single trade, they naturally begin altering their behavior. Winning makes them reckless, losing makes them careful, and both reactions break consistency. To execute an edge with precision, you must detach from the outcome of any single trade and see the system in terms of a larger sample size. You're not trading to win this trade, you're trading to allow the law of large numbers to play out. When the emotional importance of one trade disappears, consistent execution becomes much easier because your perception is no longer distorted by short-term fluctuations. Consistency also requires acceptance of randomness. Even the best edge will produce losing streaks. It will produce unexpected outcomes. It will occasionally fail in perfect conditions and succeed in imperfect ones. When traders cannot accept this randomness, they begin modifying their behavior in an attempt to control what cannot be controlled. They change their entry rules after one loss, shift their stop placement after a few deviations, hesitate to enter after a losing streak, or experiment with new setups during boredom. All of these actions reveal that the trader is trying to eliminate uncertainty rather than embrace it. But an edge only works when you allow uncertainty to exist. The edge does not eliminate randomness, it balances it over time. Accepting this truth is essential for consistency. Another layer of consistency is emotional discipline, which comes from trust in your system. Trust is not built from belief alone, it is built from experience. The more consistently you execute your edge, the more you begin to see the long-term pattern unfold. You begin to witness how a series of trades plays out. You experience firsthand how losses are recovered through structure, how wins accumulate over time, and how stability emerges despite temporary setbacks. This reinforces your confidence, making it easier to follow the rules. Consistency creates results, and results create trust. This cycle strengthens your mindset and makes disciplined execution natural rather than forced. Consistency also extends to risk management. An edge is only as strong as the risk structure supporting it. If you vary risk from trade to trade based on emotional impulses, you are distorting the outcome of your edge. A string of wins with small risk followed by one oversized loss wipes out the entire statistical advantage. Absolute consistency means risking the same percentage each time, following the same stop methodology, and not attempting to manipulate outcomes by adjusting risk. When risk management is consistent, the edge becomes measurable, predictable, and stable. Finally, executing your edge consistently allows you to operate from a mindset of neutrality. You're no longer swayed by temporary results because your focus has shifted from outcome to process. You're no longer evaluating the market emotionally, you're evaluating it structurally. This neutrality gives you psychological freedom. It removes pressure. It eliminates the need to be right. It allows you to trade with clarity because every decision is rooted in rules rather than reactions. When you reach this level of behavioral consistency, the edge begins to express itself fully, and your performance elevates from random fluctuations to structured, repeatable growth. Detaching emotionally from outcomes is one of the deepest psychological shifts a trader can make, and it becomes the foundation upon which disciplined execution, mental clarity, and long-term profitability are built. Most traders believe they are focused on strategy, but in reality, they are focused on outcomes. Every win feels like validation, every loss feels like punishment, and every fluctuation in between becomes a trigger. This emotional attachment creates a mental environment where rational thinking is constantly overridden by feelings of fear, hope, excitement, or frustration. When the mind is tied to the result of each trade, the trader becomes reactive, inconsistent, and vulnerable to impulsive decisions. True mastery begins when outcomes stop dictating emotional states and the trader learns to approach each moment with neutrality. Emotions become attached to outcomes because most people unconsciously tie their self-worth, confidence, and identity to their performance. A winning trade makes them feel competent, skillful, or lucky, while a losing trade makes them feel inadequate, careless, or unfortunate. The problem isn't the outcome itself, but the meaning the trader attaches to it. The market has no intention, no personal message, and no interest in who wins or loses. It is simply a flow of probabilities, and yet traders often take outcomes personally. This personalizing creates emotional turbulence that prevents consistent behavior. When you detach emotionally, the outcome stops being a reflection of you and becomes simply a data point. Emotional attachment also creates pressure. When a trader desperately wants a trade to work, they distort their perception of the market. They see what they want to see instead of what is actually happening. They move stops farther away because they want to avoid the emotional pain of being wrong. They take profits too early because they fear losing what the market has temporarily offered. They skip valid trades because they're still upset about the previous loss. Each of these actions is a sign that emotion is in control, not logic. The more emotionally attached you are to outcomes, the more your execution deviates from your plan. Detaching from outcomes means understanding that no single trade has any real significance in the bigger picture. You are not judged by the result of one trade, but by the collective result of many trades executed with discipline. A single outcome does not define your edge, your skill, or your future performance. It is one expression of probability among many. When you internalize this truth, one trade no longer holds emotional weight. A win does not inflate you, and a loss does not deflate you. You begin to see the market from a stable mental state, which allows you to make decisions free from emotional distortion. This detachment doesn't mean indifference or lack of care. It means neutrality. It means staying mentally level regardless of what happens. Neutrality allows you to focus on process instead of prediction. Instead of hoping the trade goes your way, you focus on whether your rules are being followed. Instead of fearing a loss, you focus on whether the setup aligns with your edge. Instead of celebrating a win as personal success, you see it as confirmation that your system is functioning. This shift from emotional reaction to objective observation is what separates consistent traders from erratic ones. Detaching emotionally also enhances clarity. Emotions cloud judgment, amplify noise, and distort risk perception. Fear makes you see threats that don't exist. Greed makes you ignore risks that are obvious. Hope makes you hold on to losing positions with the belief they will turn around. Frustration makes you jump into revenge trades that violate your plan. The mind starts interpreting the market through the lens of emotion rather than structure. When you detach from outcomes, your perception becomes clean. You see the chart for what it is, not for what you emotionally want it to be. This clarity leads to better decisions and more consistent execution. Another benefit of emotional detachment is the ability to endure losing streaks without falling apart. Every edge, no matter how strong, includes periods where losses cluster. Traders who are emotionally tied to outcomes crumble during these times. They lose confidence, alter their strategy, or stop trading out of fear. Detachment allows you to view losing streaks as statistical inevitabilities rather than personal failures. You understand that variance is normal, and as long as you follow your rules, the edge will assert itself over time. This resilience keeps you active, focused, and disciplined even when the short-term results are discouraging. Emotional detachment also prevents the dangerous effects of winning streaks. Many traders mistakenly believe that emotional attachment is only harmful during losses, but attachment to wins can be even more destructive. A trader who becomes emotionally attached to winning begins to feel invincible. They take oversized risks, ignore stops, overtrade, or assume the market is somehow obligated to keep rewarding them. This inflated confidence quickly leads to catastrophic losses. When you are emotionally detached, a win is simply another trade, not a reason to abandon discipline. Your behavior remains stable regardless of whether you are winning or losing, which protects your account from volatility caused by emotional swings. Detaching emotionally also strengthens your relationship with uncertainty. Most traders fear uncertainty because they want control. They want to know the outcome before entering. They want assurance. They want guarantees. But trading offers none of these. The inability to accept uncertainty makes traders cling emotionally to outcomes, and that attachment becomes a source of stress. When you detach emotionally, you stop fighting uncertainty and instead allow it to exist. You accept that your job is not to control outcomes, but to control actions. This acceptance creates calmness, reduces mental strain, and allows you to operate with composure even in fast-moving markets. Emotional detachment also enhances discipline. Discipline doesn't come from forcing yourself to follow rules. It comes from cultivating a mental state where following the rules feels natural. When you are no longer emotionally invested in the outcome, there is no internal conflict. You are no longer torn between fear and logic, hope and rules, impulse and structure. The mind becomes aligned with the process. Discipline becomes effortless because you are no longer negotiating with your emotions. You simply execute. Ultimately, detaching emotionally from outcomes gives you psychological freedom. You are free from fear of being wrong, free from the need to prove yourself, free from the emotional roller coaster that destroys most traders. You operate from stability rather than chaos. You follow your plan with clarity, patience, and confidence. Every decision becomes cleaner, every action more precise, and every trade becomes just another step in a larger probability sequence rather than an emotional event. Prioritizing process over prediction is one of the most transformative shifts a trader can make, yet it is also one of the most difficult. The human mind is naturally drawn towards certainty. It wants to know what will happen next. It wants to avoid risk. It wants to feel in control. Trading, however, is an arena where certainty does not exist. Every price movement is a combination of countless unknown decisions made by participants around the world, and no trader can predict the exact outcome of any single trade. The desire to predict creates illusions, biases, and emotional reactions that destroy consistency. When you shift your mindset from trying to predict the market to executing a structured process, you step into the realm of professional trading where your success is based on what you can control rather than what you hope for. Most traders enter the market with an unconscious belief that prediction equals profitability. They spend hours analyzing charts, tweaking indicators, or trying to identify patterns that promise certainty. They cling to forecasts, news opinions, or their own biases. But prediction is a trap because it places your emotional state at the mercy of every tick. When the market moves in your expected direction, you feel validated. When it moves against you, you feel threatened. This emotional dependency creates anxiety, impulsiveness, and irrational decision-making. A trader who prioritizes prediction naturally tries to force the market to behave according to their expectations, which leads to frustration and inconsistency. Prioritizing process over prediction means shifting your focus from outcomes to execution. It means understanding that your job is not to determine where the market is going, but to follow a set of rules designed to exploit opportunities whenever they appear. This approach removes the psychological burden of being right. You no longer feel the need to guess the market's next move. Instead, you act on clear criteria. The market becomes a place where you apply a method, not a place where you test your intuition. This shift creates a calmer, more stable mindset because your success is measured by how well you executed your process, not by whether the market fulfilled your expectations. When you prioritize process, you begin to see trading as a long-term probabilistic game rather than a single event prediction contest. A process-oriented trader understands that individual outcomes do not matter. The structure of the system matters. The consistent application of rules matters. The management of risk matters. You no longer panic when a trade goes wrong because you know it is part of the probability distribution. You no longer get overly excited when a trade goes right because it is simply the positive expression of your edge. This mindset prevents the emotional volatility that leads to poor decisions. Process-focused trading also reduces cognitive load. The brain becomes overwhelmed when it tries to analyze every detail or predict every movement. This overload leads to hesitation, second-guessing, and emotional overreaction. A structured process simplifies decision-making. You know exactly what to look for, when to enter, where to exit, and how much to risk. The clarity removes confusion and makes action smoother. This is why professional traders consistently use predefined systems. They eliminate random decision-making. When your brain is free from prediction-based stress, your performance naturally improves. Another important aspect of prioritizing process is the consistency it brings to your overall performance. Prediction-based trading is inherently inconsistent because it depends on constantly changing emotions and interpretations. One day you feel confident and take aggressive trades. The next day you feel uncertain and avoid valid setups. This inconsistency destroys the edge of any strategy. But when you follow a structured process, your behavior becomes stable. You take trades when the criteria are met, no matter how you feel. You avoid trades when the conditions are not present, regardless of temptation. This stability allows your edge to unfold across a large sample of trades, which is the only way true profitability emerges. Prioritizing process also teaches humility. Prediction encourages ego. It makes you believe you can outsmart the market. Even when unconscious, there is a subtle belief that being right is a sign of intelligence. But markets are not conquered by intelligence alone. They are approached through discipline, structure, and acceptance of uncertainty. When you follow a process, you stop trying to prove anything. You no longer attach your identity to outcomes, you simply do your job. This humility frees you from the pressure to be perfect and brings a deeper level of focus to your execution. Another powerful benefit of a process-oriented mindset is that it eliminates the emotional highs and lows that come from trying to be right. Prediction is tied to ego, and ego is tied to emotional volatility. When you think you know what will happen, the market becomes a source of emotional gratification or emotional pain. A win inflates you and a loss damages you. This roller coaster leads to deviations in behavior. When the process is your focus, you detach emotionally. A loss doesn't hurt because it's just part of the system. A win doesn't inflate you because it doesn't validate anything. Your emotional baseline stays stable. Prioritizing process also sharpens your ability to adapt. Prediction creates rigidity because you become attached to a particular storyline about the market. When the market deviates from your expectation, you resist, ignore signals, or cling to losing trades hoping they come back. A process-based approach allows you to flow with changing conditions. You follow what the market shows rather than what you want to see. Your response becomes flexible, not because you're predicting differently, but because your process includes rules for different environments. This flexibility increases survival and performance during volatile periods. Another critical effect of prioritizing process is improved risk management. Prediction makes traders overly confident when things go well or overly hesitant when things go poorly. They often increase position sizes due to the illusion of certainty or reduce them out of fear. A process-oriented trader maintains consistent risk parameters because they understand risk is part of the structure. They don't adjust it impulsively. This consistency in risk management is what allows long-term compounding to work because small, controlled risks applied consistently create stability and growth. Finally, prioritizing process builds long-term trust in yourself and your system. Every time you follow your rules, you reinforce the belief that you can rely on your own discipline. Every time you execute without trying to predict, you strengthen your psychological foundation. This trust becomes a powerful mental asset. It keeps you grounded during losing streaks and prevents destructive overconfidence during winning streaks. It creates a trading identity built on discipline rather than emotion, structure rather than impulse, and clarity rather than chaos. Maintaining unwavering discipline under uncertainty is the core skill that separates traders who succeed consistently from those who remain trapped in cycles of emotional decision-making. The market is an environment defined by unpredictability. No amount of analysis, experience, or intuition can eliminate the randomness embedded in every price movement. You can have the best strategy, the most sophisticated system, or years of screen time, but without discipline, none of it can be expressed effectively. Discipline is the bridge between knowledge and execution. It is the ability to do what needs to be done regardless of how you feel, what the market tempts you to do, or how uncertain the situation appears in the moment. Without unwavering discipline, uncertainty becomes a psychological threat. With it, uncertainty becomes simply a condition of the environment you operate in. Uncertainty creates emotional tension. Every time you place a trade, your mind naturally wants reassurance. It wants confirmation that the trade will work. It wants a sense of safety. But trading offers no guarantees. This gap between wanting certainty and not having it triggers emotional impulses. Fear, hesitation, greed, excitement, doubt. These impulses constantly pull you away from your rules. Discipline is the force that keeps you grounded when your emotions want to push you into impulsive action. It is the internal authority that overrides the instinct to react based on feelings rather than structure. Most traders underestimate how much discipline they actually need. They assume discipline is simply the ability to follow rules, but true discipline is deeper. It is the capacity to remain stable while facing the discomfort of uncertainty. It is the ability to stay committed even when emotions scream loud. It is the willingness to execute your edge over and over again, even when the last few trades went against you. It is the strength to not chase after a missed move, to not widen a stop, to not exit early out of fear, to not increase risk out of excitement. Every moment in the market tests your discipline because every moment contains uncertainty. Unwavering discipline means having a consistent set of rules and adhering to them without bending, modifying, or negotiating with yourself. These rules guide your entries, exits, risk, position size, and conditions for avoiding trades. Most traders break their own rules not because they don't know them, but because uncertainty activates emotions that override logic. A disciplined trader has trained themselves to act independently of emotional urges. They understand that their rules exist specifically to protect them from the emotional distortions caused by uncertainty. Every time you follow your process despite emotional pressure, you strengthen your discipline. Every time you deviate, you weaken it. Uncertainty triggers cognitive biases. The fear of missing out urges you to jump into trades that aren't part of your plan. The fear of loss makes you hesitate or second-guess legitimate setups. The desire to avoid emotional pain makes you cut winners too early. The need to be right makes you hold losers too long. Discipline is what neutralizes these biases. It gives you the mental power to override emotional impulses and stay aligned with your system. When you operate with discipline, you are not fighting the market, you are managing your own internal reactions. Most trading failures come not from bad market conditions, but from undisciplined responses to uncertainty. Another dimension of discipline is patience. Patience is not passive, it is active restraint. It is the discipline to wait for the exact conditions that define your edge instead of reacting to noise or impulses. Many traders sabotage themselves by entering too early, chasing moves that already happened, or forcing trades during slow conditions. These actions stem from discomfort with waiting. Uncertainty during waiting periods creates restlessness. Discipline is what allows you to wait without forcing action. Disciplined trader understands that opportunities come to those who preserve their capital while waiting for high probability setups. A crucial element of unwavering discipline is emotional neutrality. Discipline becomes almost impossible if every trade becomes an emotional event. The more emotional weight you attach to outcomes, the harder it becomes to act consistently. When you are emotionally tied to being right or avoiding loss, discipline collapses under pressure. Emotional neutrality doesn't mean you stop caring. It means you're not controlled by emotional reactions. A disciplined trader has learned to experience wins and losses with the same psychological balance. This stability makes it easier to follow rules because your decisions are no longer influenced by the emotional fluctuations created by uncertainty. Uncertainty also tests your confidence. When trades go wrong or the market behaves erratically, your belief in your system and your ability can weaken. Without confidence, discipline deteriorates, but confidence must be built on consistent practice, not outcomes. Every time you execute your rules despite uncertainty, you reinforce confidence in your discipline. You prove to yourself that you can act with structure even when your emotions try to sway you. This self-trust becomes your anchor during volatile conditions. The more your discipline is tested and maintained, the stronger your internal confidence becomes. A disciplined trader also understands that uncertainty does not change the nature of their edge. A losing streak does not mean the edge disappeared. A series of winning trades does not mean you've gained the ability to predict the market. Discipline keeps you grounded in the reality that outcomes vary, but process remains constant. This grounded perspective prevents you from panicking during drawdowns or becoming reckless during winning periods. The disciplined mind remains consistent despite the unpredictable nature of short-term results. Maintaining discipline under uncertainty requires self-awareness. You must be able to recognize the early signs of emotional interference: tightness, urgency, fear, impatience, overconfidence. Discipline is not just the act of following rules, it is also the awareness of when emotions are trying to break those rules. A disciplined trader monitors their internal state with the same focus they give to the charts. They understand that managing themselves is part of managing their trades. Another aspect of discipline is the ability to accept losses without emotional resistance. Many traders break their rules because they cannot accept the discomfort of taking a loss. They hesitate to exit, move stops, or rationalize staying in a losing trade. Discipline allows you to accept losses as part of the statistical structure of your edge. Accepting uncertainty includes accepting that losses will occur, sometimes repeatedly. When losses no longer threaten your emotional stability, discipline becomes easier to maintain. Finally, maintaining discipline under uncertainty transforms the way you experience the market. Instead of reacting to every movement, you respond only when your system signals action. Instead of trying to control the market, you control your behavior. Instead of being pushed around by emotion, you move with intention. Discipline becomes your internal guide, shaping your decisions, stabilizing your mindset, and keeping you aligned with your long-term goals even when short-term conditions are unpredictable.